You don't get broken by one bad trade. You get broken by the small mental choices you repeat when nobody is watching. The tiny rule bends. The quiet, just this once. The little exceptions that feel harmless because they're not dramatic. Until one day the market moves fast, your emotions move faster, and your account shows you the bill for every shortcut you've been taking. Here's a stat most traders avoid because it hurts, but it's useful. Across many brokers' risk disclosures under SMA-style rules, a large majority of retail CFD accounts lose money, often around 3/4 or more. That doesn't mean you can't win. It means the default path is losing, and the reason is rarely a lack of indicators. So what's the compounding mindset traders ignore? It's the mindset that your process compounds faster than your strategy, that the smallest behaviors become your real edge or your real destroyer. And the market doesn't punish you for what you know. It punishes you for what you repeat under stress. AI doesn't control your trading, but it can amplify what breaks you, because your trading environment is now algorithmically optimized for stimulation. Alerts, news flashes, social feeds, hot takes, prediction content that rewards certainty and speed. If your mind already has a weakness for urgency, modern tools pour fuel on it, and you start confusing activity with progress. Mark Douglas built his entire message around one painful truth. Consistency comes from thinking in probabilities and executing the same way, not from needing to be right on the next trade. The compounding mindset is accepting uncertainty without trying to buy certainty with impulsive clicks. Subscribe to Mind for Trade and click the bell, and watch till the end. Because you're going to leave with a simple system that helps your discipline compound instead of your mistakes compounding. And it works even when you feel emotional. Here's what it looks like when the compounding mindset is missing. You start the week disciplined. Clean entries. Defined risk. You're proud. Then you take a small loss and it stings more than it should. Not because it's big, but because it feels like you were wrong. You tell yourself you're still following your plan, but you start scanning faster. You take the next setup a little earlier than usual. You justify it. It's close enough. Then you take another loss. Now you feel urgency. You raise size slightly because you want to get back to even. You don't call it revenge, you call it efficiency. And then the market does what markets do. It whipsaws. You get hit again. Now you're not trading your strategy anymore. You're trading your emotional timeline, and you don't even notice the exact moment it changed. That's why it's so dangerous. You felt this version too. You're up on the day, maybe even up nicely, and your brain starts relaxing. You feel smarter than you are. You take a marginal setup because you feel like you've earned it. You widen a stop because you don't want to give back profits. You take profits too early because you want to lock the win. You start managing the chart like you can control it. Then one sharp move takes back a chunk, and you feel the mood shift. The same mood shift that creates bad decisions. It starts small, then it snowballs. Here's a pattern interrupt that exposes it. Do you follow your rules best when you're calm, but break them when you're either excited or frustrated? That's the compounding mindset gap. You think discipline is a personality trait. It isn't. Discipline is a system that survives mood. The hidden habit is subtle, but it controls trades automatically. It triggers when you overtrade, hesitate, or chase losses. It's the habit of treating trading as emotional regulation. You use trades to change how you feel, to get relief, to get control, to erase discomfort, to prove you're still good. Most traders don't say that out loud. They say it's strategy, but the behavior shows the truth. You hesitate on a good trade because you want certainty. Then you chase because missing it feels worse than losing. Then you overmanage because watching price move against you feels like danger. Then you move the stop because admitting you're wrong feels like failure. Then you double down because you want to avoid the emotional pain of a realized loss. And the worst part is that every one of these choices feels logical in the moment. One more piece of reality that makes this believable. Kahneman and Tversky's work on prospect theory showed that losses generally hit harder than gains feel good, roughly about twice as powerful psychologically. So when a trade goes slightly red, Your mind can react as if something serious is happening, even when it's normal market noise. So you don't need a stronger mindset in a motivational way. You need a compounding mindset in a practical way. A mindset that treats small choices like they matter, because they do. Did you just recognize the danger? It's not the big mistake. It's the small permission. Many retail traders repeat this mistake unknowingly, over and over. They think the breakthrough is a new indicator or a new entry model. But the real breakthrough is stopping the micro-rule breaks that accumulate into a blown week. Now let's talk about why it matters. Because this is where the market gets cruel. The market compounds returns and losses mathematically, but it also compounds behavior psychologically. When you break a rule and it works, your brain gets rewarded for bad behavior. That's one of the most toxic lessons in trading. You move a stop, price comes back, and you feel relief. Your mind learns that bending rules is protective. Then you do it again. Then one day price doesn't come back, and that same habit takes a small planned loss and turns it into a painful one. Chasing losses immediately. Freezing in hesitation. Ignoring clear risk signals. That's how traders get broken without one dramatic moment. They get broken by the gradual erosion of trust in their own process. Think of your mind as a trading algorithm, missing crucial risk checks. A good algorithm doesn't care how it feels. It runs the risk rules every time. But your mind under stress will skip checks to reduce discomfort. It will optimize for emotional relief. And emotional relief is not the same as profitability. Here's a real scenario that shows how this breaks people. A trader has a perfect entry, the setup is valid, risk is defined, and the trade is fine. But the first pullback triggers fear. So they exit early. Then price runs without them. Now they feel regret. So they chase a worse entry. Then the normal pullback hits again, and they panic. And now they've turned a good setup into a sequence of emotional actions. Nothing about the market changed. Their state did. Another stat that should sober you up in the right way comes from research by Barber and Odean on individual investors. More frequent trading tends to be associated with lower returns, often explained by costs and poor timing. The more you click to feel in control, the more you may be paying for the illusion of control. So why does the compounding mindset matter? Because the market is not only testing your strategy, it's testing whether you can stay consistent across different internal states. Calm state, excited state, frustrated state, tired state, after a win, after a loss, when you're bored, when you're distracted. If your execution changes with your mood, your results will never stabilize. And that's why traders feel like they're always almost there. If this resonates, hit like and comment which habit is silently sabotaging your trades. Hesitation, revenge, overtrading, cutting winners early, holding losers too long, needing to be right. One word. Most traders never notice the compounding mindset problem because it doesn't feel like one big failure. It feels like 100 small moments that are easy to rationalize. And it costs more than money. It costs confidence. It costs identity. It costs the ability to trust your own eyes. Now here's the difference between retail traders and pro traders, and it ties directly to this title. Retail traders often treat discipline like a mood. If they feel confident, they increase size. If they feel nervous, they hesitate. If they feel annoyed, they force trades. Their rules are real in theory, but flexible in practice. They trade their state, then blame the market for being unfair. Pro traders treat discipline like infrastructure. They assume they will feel fear. They assume they will feel overconfidence. They assume they will have tilted days. So they build systems that reduce the damage of predictable human moments. They use position sizing, predefined exits, and hard constraints to protect themselves from themselves. Retail traders try to make back losses quickly. Pro traders try to stop the bleeding early. Retail traders think discipline is not clicking. Pro traders think discipline is only clicking when rules are met. That's the compounding mindset. Your job is not to be perfect. Your job is to be consistent enough that your edge can actually show up. Now let's fix it. With micro solutions that are beginner-friendly, practical, and real. First, You track your emotions every trade, but you do it in a way you'll actually maintain. Before the trade, write one word for your state. During the trade, write one word for what you felt most strongly. After the trade, write one word for what you feel now. Then write one more thing. Did I follow my rules? Yes or no? That's it. No essays. This matters because awareness is the first step to control. But vague awareness does nothing. Specific awareness changes behavior. When you see that most rule breaks happen when you feel urgency or boredom or after a win, you stop thinking your mistakes are random. You see the trigger. Second, you pause before executing trades, because the most expensive decisions usually happen right before the click. You ask yourself one question, the same question every time. Am I reacting or am I following a plan? If you're reacting, you wait. If you're following a plan, you execute cleanly. The goal is not to eliminate emotion. The goal is to stop emotion from secretly becoming the decision maker. Are you already doing this? Or does it feel completely new? Here's how this looks in real life. You see a setup and your brain says, "Take it now, it's moving." Your pause catches the urgency. You realize you're about to enter because you're afraid of missing out, not because the setup is confirmed. You wait. Either it sets up properly and you take it clean, or it runs without you and you stay stable. And staying stable is part of compounding. Third, you use AI-assisted probabilistic thinking, but in a believable way that actually helps. You do not use AI to predict price. You use AI to summarize your behavior and your stats so you stop lying to yourself. You keep a simple log of your trades and your emotions. Then you ask AI to find patterns you might miss, like which setups you execute worst, what time of day you deviate from rules, whether you cut winners early, whether you hold losers longer than planned, whether your biggest losses happen after you've already taken a loss, or after you've had a win and feel invincible. AI becomes your mirror, not your signal provider. And when it reflects a pattern back to you, you stop making it personal. You treat it like data. That shift alone is powerful because shame keeps you stuck and data makes you trainable. Here's a pattern interrupt that will save you money if you use it. Did you just feel the urge to take a trade to change your mood? That's the compounding mindset moment. Because the compounding mindset is not about one trade. It's about catching the state shift early and protecting your process. Now add one more tool that turns this into something that sticks. You create a simple rule for state-based protection. When you feel tilted, you reduce activity. When you feel euphoric, you reduce risk. That sounds backwards to beginners, because beginners think confidence means increased size. Pros know confidence is when you're most likely to get sloppy. So you build a constraint that triggers automatically. After a big emotional hit, you pause trading and review. After a strong win, you keep size steady instead of scaling up impulsively. After 2 impulsive urges in a row, you stop and reset. Not because you're weak, because you're managing a system. This is how pros stay alive. They manage downside on bad states. Now let's go deeper, because this title is really about one thing. The compounding mindset traders ignore is that your process is either compounding for you or compounding against you. Every time you follow your rules, you strengthen the identity of someone who follows rules. Every time you break your rules, you train your brain that rules are optional when you feel something intense. And your brain learns fast. Most traders don't realize this until it breaks them, because the breaking point often comes after a long stretch of almost profitable, almost consistent, almost disciplined. Then 1 week of emotional decisions wipes out months of progress, and they say, "I just need a better strategy." But the strategy wasn't the issue. The issue was the compounding of small exceptions. What is the invisible habit controlling your trades? It's using trades to regulate emotion and allowing micro-rule breaks to stack up. Why does it break you? Because it builds unconscious risk, triggers emotional reactions, and undermines consistent results. It teaches you to chase relief instead of execute an edge. How do you regain control? You install micro-actions that force your brain to slow down at the moments it usually speeds up. And you use structured risk management plus AI-informed self-feedback to expose patterns and correct them early. Here's the most practical reframe you can hold on to during a real session. Your job is not to win this trade. Your job is to execute the next decision correctly. Then the next decision. Then the next. That is compounding. One clean decision. Then another. And here's the cliff that most traders fall off. So I want you to hear it clearly. If you do not build a way to handle discomfort, you will eventually pay for comfort. You will pay by taking profit early. You will pay by moving stops. You will pay by revenge trading. You will pay by overtrading. You will pay by avoiding good setups after a loss. You will pay by forcing bad setups when bored. Discomfort is not danger. It's part of the job. Brett Steenbarger, a trading performance psychologist, emphasizes deliberate practice and feedback as the path to improvement. For you, as a beginner, that means you don't need a perfect mindset. You need a tighter feedback loop. You need to know exactly when you broke rules, what you felt, and what triggered it, so you can train the response. Now for the identity shift, because this is how it sticks long term. You don't need to become a trader who is always calm. You need to become a trader who can feel everything and still follow the plan. You become a conscious risk manager, someone who controls micro decisions, someone who protects their future self from their current emotions, someone who understands that discipline is not a mood, it's infrastructure. AI can't take that from you. AI can amplify noise, it can feed urgency, it can make impulsive behavior easier, but it cannot easily predict your deliberate actions because deliberate actions are not your defaults. They are choices. So here's your final question, and it's simple. Are you compounding your edge, or are you compounding your exceptions? Subscribe to Mind for Trade if you haven't yet, hit like, and comment which habit you're focusing on first. And the next time the market tries to pull you into urgency, remember this: the trade is not the main test. The mindset that compounds is the main test.